Hey guys,
Good morning.
how you doing?
Great.
Getting through.
A little tepid this morning.
Tepid. My wife had a project due in her class last weekend, so I was on full-time dad duty, and so got a lot of time with the lad. But I hit like train limit at a point on Sunday after I took him to the train park. There's like a park of model trains that you can ride on, and he got amusement park problems.
Oh geez, we got my son's second birthday was this weekend, and we got him laser tag.
Oh man!
And the big debacle was he didn't want to face it the right direction, and then he got upset that he was shooting himself. So that's 2-year-old problems right there.
Yep.
How's it going for you, Dean?
Pretty good. I'm still getting over the truck show on the weekend out in Pennsylvania. Was hot and dusty. A lot of fun. We had about 300 trucks there raising funds for cystic fibrosis, but it was good to catch up with a bunch of owner-operators and get some good intel on what's happening in the market. There's certainly no shortage of freight in the flatbed space. That was the one thing that stood out to me. The other thing I noticed there was a number of the one thing that really stood out was a couple of livestock trailers were actually hauling palletized freight, which normally you see hay. You can see hay in the back of livestock trailers because it's sort of backhaul freight, but they built a flat floor and from the decking that folds down for the hogs, and we're actually loading palletized freight in there, which is just shows you how busy things are in some sectors.
That's interesting.
Yeah.
Where was it in PA? You're dealing with a pretty PA-centric audience here.
Yeah, Millhall, PA. So it's just west of the Baseball Hall of Fame. So.
Oh, okay.
Yeah, deep in farming country. There's a lot of regional haulers there, especially in construction and agriculture. A lot of dump trucks. You see a lot of dump trucks around Pennsylvania anyway. But PA trucks have kind of got a unique look to them. There's a few parts of the country where the truckers take a lot of pride in their equipment. Michigan's one, California's the other. New Jersey are famous for their triaxle dump trucks, and Pennsylvania are just they've got a variety of trucks, but the owner-operators take so much pride in their equipment. It's amazing.
Well, hey, I think we're going to get started if that's all right with you guys.
Mm-hmm.
Mm-hmm.
It's National Coffee Day, so I hope everyone is all,
would that it work, Ken? Would that it work?
All right. So I want to welcome everyone who's watching live. This is our weekly DAT IQ market update. This is our last update for September and also for the third quarter of 2020. The next time we see you guys, it will be October, and it will be the fourth quarter. I know that's incredibly hard to believe. I'm Ken Adamo, Chief of Analytics at DAT, joined by the uncaffeinated Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Welcome, guys.
Hey, Ken.
Great to be here.
It is great to be here. We have some really exciting stuff to talk about this week. We actually have some spillover questions from last week. We ran out of time. So in the interest of time, I'm going to jump right into it with our key points of the week. So this week, we're seeing some interesting trends across our 3 equipment types. We're seeing dry van spot rates slowing down a little bit in their rise. Dean's going to talk a little bit about that here in a few minutes. Reefer's cooling for sure. That's a great pun. Dean wrote that line. But flatbed is still climbing. And if you caught some of our banter to start the show, you see some of that at some of the truck shows and some of the anecdotal feedback that we're hearing. Dry van and reefer load and truck post volume was down week over week. And some really interesting dynamics between the spot and contract market. So we're seeing spot market volumes up considerably versus August 2019. But FMIC in their August contract freight report saw volumes down. And if you look at a lot of the credible volume metrics, ATA, CAS, and others, we continue to see those mixed signals largely based on industry. So without further ado, I'm going to turn it over to Dean to get into our market update for the week.
Yeah, thanks, Ken. So let's dive straight into the supply and demand update. We'll start with the dry van load board activity. The load to truck ratio for dry van moved up slightly last week, up about 3% to 5.27. Both truck and load post volumes did decrease, but trucks posted decreased at a faster rate, causing the differential. We're still tracking really closely to 2017. But not only are load posts up 50% year over year, they're also 3% higher than the peak in June of 2018, which speaks to the dislocation we're seeing in the market and the point Ken just made about the increase in freight that's moving on the spot market this year. On the reefer side, the reefer load to truck ratio, the very little change this week. It moved up just 1% to 9.01. Very similar trends to dry van. Reefer load and truck post volumes both decreased last week. But interestingly, both are at or near 4-year highs. On the flatbed side, very different scene over there because load posts increased about 2% last week. So there's still a lot of activity in the flatbed sector. The load to truck ratio increased about 6%. And of the 3 equipment types we track, whether you're looking at load posts or trucks posting for loads or the load to truck ratio, they're tracking the closest to 2017 in terms of seasonality, which is, of course, the season where we started to move into the early 2018 period where we had double-digit rate increases. Moving over to the market condition index this week, in dry van, we can see a lot of imbalance that Ken touched on a little bit earlier, both at the lane, market and commodity level. Our freight market intelligence tells us that retail and consumer goods shipper volumes are up about 10% month over month, while industrial products are down about 10% in August. So even though volumes, according to FMIC, are down about 3% year over year, August spot market volumes are 80% higher than they were this time last year. So normally about 12 to 15% of freight moves on the spot market. In August, it was up around 21%. Notable markets to watch on the MCI index this week. We're noticing on the West Coast that volumes in Ontario and Los Angeles posted another gain this week. They're up 14% week over week. And that was after a 16% week over week increase the week prior. A lot of that freight appears to be warehouse related freight heading to Denver, Stockton and Phoenix. About 15% of load post volumes were destined there with their notable warehouse markets, reflecting some of the surge in import volumes. Similar effect in Savannah on the East Coast. Volumes in Savannah on the outbound side were up about 18% week over week. Moving to the refrigerated market condition index, the fall season is still keeping volumes high on the West Coast. In Southern California, about half of our produce for the entire United States comes from that market. So in the Central Valley, which is a 60-mile long stretch running from Bakersfield north, the Fresno market is sort of hitting its peak, in particular with its number one fall season crop, which is grapes. Volumes out of Fresno are up 15% week over week, but there's plenty of capacity at the moment with some downward pressure on rates. They dropped 5 cents a mile to $2.65. Further over on the East Coast and Southern Florida, a little bit of activity in the Lakeland market, as you can see in yellow down in Florida. Avocados are in peak season. Volumes are up 8% week over week out of the Lakeland market, but rates are still pretty low. It's still deep backhaul territory, and reefer carriers are only pulling about $1.27 a mile. What I did notice this week was interesting was that further west in southern Texas, capacity did tighten in Dallas, San Antonio, McAllen, and Laredo. Rates jumped up about 14 cents a mile to $2.18, which was sort of the most notable in the Western markets this week. On the flatbed side, still seeing a fair bit of subdued activity in the manufacturing side. Shipments of things like primary metals, fabricated metal products, machinery. According to the US Census Bureau, they're all down about 8% year over year. But there are some signs that those manufacturing volumes are improving steadily month over month. In contrast, though, the big winner this year has been anyone hauling wood products or building materials. Those shipments are up 6% year over year. And if we look at our southeast markets, you can see a lot of bright red there. A lot of load posting activity in the lumber and home building markets around Atlanta and Macon. They're up 13% week over week. So shifting over to the spot rate side.
Hey, Dean, before you get to spot rates, sorry to interrupt you. We have a question from Giovanni around current market conditions in the Southeast region. And I'm going to presume it's either for dry van or reefer, but can you elaborate? Because it looks like Atlanta, even like Decatur, Savannah are all red hot right now, pushing up against 100 MCI. Can you maybe elaborate on that a little bit?
Yeah, the Southeast is typically, well, for flatbed in particular, Southeast is about where 55% of all single-family housing starts are built. So we're seeing a lot more activity there for two reasons. One is people are moving to more rural areas due to the pandemic and homes that are more conducive to working from home. But you're also seeing the tail end of the recovery from the hurricane season. Even though it's still happening, we've seen a lot more flatbed activity in those particular areas. So a couple of things. One is the demand for new homes and materials associated with that, which can be both dry van and flatbed. And of course, reefers can haul those sorts of things like carpets and furnishings and fittings also. And on the flatbed side, a lot of that's got to do with the amazing increase in new housing starts in the south. And in particular, the New Orleans market and up through the Mississippi Valley there, where they've been recovering from the recent flooding.
All right, cool. Thank you.
Okay, on the rate side, the spot market, definitely some cooling off in the spot market for dry vans. It slowed last week, so the rate of increase slowed. It's the first in 5 months that we've seen this persistent upward week-over-week rate increase start to slow down a little bit. So that was noticeable when we looked at the 3 and 7 day moving average data. It was evident that there was some wobbling in the daily rates. It's still very high for the first year, the first time in 5 years. So where they go from here, I'm not sure, but there is some evidence that rates are starting to slow down a little bit in terms of the rate of increase. Very different in the reefer market. National average reefer rates seem to have reached their point of resistance, settling around $2.36 a mile. Definite plateauing effect, but we're still in record territory for late September. And of course, we normally see reefer rates spike in late June, early July, around the 4th of July. This time we're seeing rates still at very high levels 2 months after the normal time that we see rates start to cool. So we're in uncharted waters there. On the flatbed side, still a little upward pressure on rates there. They settle about $2.22 a mile. I think this reflects, to answer the previous question from a few minutes ago, it reflects the strong demand in the building and construction industry related to both home starts and hurricane recovery efforts. Spot rates on the flatbed side are about 6 cents a mile higher than this time in 2018. So that's this week's market update for supply and demand. Over to you, Ned, for the rate forecast.
Before you leave, Dean, I do have a question. So after the fun that I had about predicting where rates are going to be going into the future, I'm interested if I can interest you folks in a wager, and that is a Price is Right style. Where do you think dry van rates will be before Halloween? And those that lose will be dressed up in appropriate Halloween-y costumes.
I'm in.
Yeah, I'm in.
Okay. All right.
I'm in.
Dean, do you want to go first about what you're...
I'm a little bit bearish. I'm going to use weather as one of my go-to metrics that I watch this time of the year. Normally this time of the year we start to see temperatures cool, produce seasons winds down, fall produce starts to dissipate, building and construction start to slow. Normally what you see is that those carriers that were busy in refrigerated and flatbed, that capacity starts to move back to the dry van market because reefers can haul dry van freight just as easily. And I do know that a lot of carrier friends of mine will swap out their flatbeds for other trailers and haul dry van freight. So I expect capacity will increase in the dry freight space, and that will put some downward pressure on rates.
So if you were to give a number to that, and remember, it's Price is Right rules, closest without going over the actual rate.
Let's level set where they are this week. So we're at what, 222 a mile?
222. Yeah, I'm thinking by October 26 down to 210. I think that's where they'll be.
210. Ken?
Oh, you've got to go next. I might throw the $1 in there.
The dirty play. I don't feel like there's as much of a reason for this trend to keep breaking. The short term keeps short-terming up into the right. So I'm gonna shoot for 230 a mile.
Wow.
Yeah, just for kind of symmetry, I think I'm probably going to go in at 220 a mile. I think we might see a little travel up and down, but I expect retail to be strong. I think this is going to be quite possibly a historic retail season for the United States. So we'll see what happens.
All right. And then I think that's
right, Ken.
Yeah.
Well, it depends, right? As a consumer and as someone who has to spend money for merchandise, I hope I'm wrong. But as someone whose ability to buy said goods is tied to the freight market, I hope I'm right.
Yeah. But I spoke to a friend of mine on the weekend, and he said he's running for $2.35 to $2.50 a mile on e-commerce freight, and he's never been busy. And of course, just 12 months ago, that wouldn't have been a very successful business model because rates were so low. The capacity was pretty loose. So things change a lot in 12 months. But right now, there's certainly boom times for anybody in the consumer packaged goods space.
Ned, before you get into the forecast, can you call out when you're there what Ratecast is actually predicting? Because Ratecast could win this bet.
Ratecast could win this bet.
It's a non-sentient algorithm. It could win.
I certainly will. So we're going to move into our forecast model discussion. So this is our standard spaghetti plot. So in blue, you see the market rates observed by DAT, and then off to the right, you see our forecast models. So in red is our short-term model, which is what I was going off of. In yellow and gray, we have our blended forecast, which are mixtures of the short-term and the Ratecast model in different ways and in different amounts. And in green, we have the Ratecast model. So Ratecast, it's looking like is shooting for just above 215 a mile, or just about 215 a mile going into that week of October. So that would be the non-sentient competitor is more bearish than anybody. I do believe. And then up in the short-term model is looking at 235, 240 a mile. And I shaded that down under Price is Right rules to try and make sure that I don't lose.
So the Ratecast model is closer to what Dean's predicting.
Yes.
And the model that forced you to eat your hat is closer. So you're siding with your former enemy. Is what you're saying.
Correct. I know when I'm beaten, and I am more than willing to switch sides in the model wars when circumstances point in that direction.
I'm more of a blended guy myself, but go on.
Moving forward to the reefer forecasts, in blue again are the historical market rates observed by DAT, and then off to the right we have in red the short-term model that looks like it's shooting for above 245 going into that week. The Ratecast model looks like it's shooting at about 230 going into that week, and the blended models are in the middle. And here I feel like the blended models are, or the Ratecast model are more likely to be correct, given that we're seeing that plateauing effect, but I wouldn't count out the short-term model. And then moving on to flatbed, again, same chart. Different data, but the same style of chart. Blue is the actual market rates observed by DAT. And then off to the right, we have our spaghetti. Again, we see that same level of divergence where the short-term model is expecting continued up and to the right, ending up at above 225. The Ratecast model is expecting gravity to win and shooting for about 215 going into that period. And then the blended forecasts are expecting a plateau at about 220 a mile. I think that's it for the forecast. So I think that brings us to our Ask IQ question for this week.
That it does. Do you want to take it away with that, Ned?
I'd be happy to. So the question is, as I pull it up, if rates start to fall, at what point should we panic? Ken?
It's a very sensationalist way to ask the question.
I don't write the copy.
How many times do I have to say black swan to get my bonus this week? I think never is that you should never panic, right? I think that's the fundamental guidance.
Don't panic is written on the cover of a very important book.
Yes. But if you think about it, right, if you look at the stock market, if you look at commodity markets, or just about anything, new gaming consoles, the prices run up and then they contract back down on the secondary market. You tend to get overbought and oversold. And that initial contraction back is more to a level of reality. So I wouldn't be surprised if rates pull back and then, continue to climb upward. We're kind of overdue for a correction. One thing I wanted to stress is after the return season, which is usually around the second or third week of January, things are going to slow down. It's just there's a holiday hangover. There's not as much stuff to ship. So the tail end of January, February, and early March, even if it's by 2020 terms, is going to be slow. My advice would be not to panic. Don't buy into the hype that the sky is falling. Understand that there are seasonal patterns at play, and regardless of how strong next spring is, there will be an upturn as we head into spring produce. It's hard to believe, right? But we'll be thinking about next spring and 4th of July right after Christmas. At least us freight analysts will. So that's sort of my general guidance.
Dean?
I would agree with Ken not to panic, but some of the advice that I was giving to some other carriers on the weekend particularly guys that were just starting out, and they were asking the question about how high will rates go. And I said, well, there is, for the end of the year, things look pretty good, but into the next year, especially in the first quarter, things should slow down. They typically do. And my advice was start putting some cash aside now, because rates are unseasonably high in a number of sectors and a number of commodities. So my advice would be don't panic, but also start thinking about building a buffer for January, February next year, when we expect things will slow down for a few reasons. One, Ken just mentioned about return season, but it's also when you have Chinese New Year, where effectively imports slow down for a 3-week period. And that'll be sort of late January into early February. So there's a couple of things that'll be working against the market. We're already seeing a lot of retailers adding, Giant and Food Lines reported in Journal of Commerce this week that they've added 10 to 15% more inventory in anticipation of another surge in COVID and an increase in buying patterns. They're building these pandemic pallets that are essentially pallets of freight that are ready to go in the event that there's a surge in demand during the winter months. So we could be seeing quite a bit of pre-positioning of freight now as opposed to later in the year. That's why I think that the early parts of the new year will be much slower than what we expect.
I would like to just add one thing to that. And I feel like the advice not to panic is very strong, but I think that there is a real possibility that the correction might be semi-permanent, right? Like if you think back to after 2018, right, rates were up in the stratosphere and then they fell back down and they stayed down through most of 2019. Mm-hmm. And so if your business model relies on having like 220 flatbed rates, mm-hmm. and you're going to go broke if you don't get $220 a mile flatbed rates, maybe you should think long and hard about what you're doing.
Well, we're seeing the same thing play out now that we did in 2018 when rates were up around the same levels, and then of course we had record levels of new truck and trailer orders into the industry that mm-hmm. sort of arrived on the market in the middle of 2019, which added to this excess capacity. So we're almost heading back into that area. 12 months ago rates were at $1.55 a mile, so they were 67 cents a mile lower exactly 12 months ago this month. So, if you're looking at where you put your operating costs and where you fix your margins, you certainly wouldn't want to be doing it on these rates today.
You did mention something, and that's after 2018, you saw a real surge in trailer buying and in just capacity expansion. Have you on the ground seen a lot of capacity expansion, or are people kind of keeping their powder dry on that?
No, I'm seeing a lot of growth in the short haul, smaller fleet market. There's been a substantial increase in owner-operators who have entered the industry, just like they did in 2018 when spot rates were high. Orders typically follow price, and we're seeing the same thing happening now. Whereas on the higher fleet size, we're seeing the opposite effect, where there's a bit of shedding of capacity. It's harder to find drivers. There were suggestions that driving schools were hard to get drivers through, hard to get your licenses processed through the regular authorities. So there's some validity to that. So I think the larger fleets have had a harder go at hiring drivers, but there's certainly been a surge on the short haul, smaller fleet side that's predominantly related to the e-commerce retail freight boom.
Speaking of e-commerce, we have a question coming in from Jessica. Is there any way we can get some insider analytics on the LTL side of the industry?
Yeah, we can make it a point as a follow-up. The FMIT side of our business has a considerable amount of data on LTL, so we can take that, put a pin in that and take it as a follow-up. Anecdotally, I could share based on my contacts that they're just absolutely booming at the moment. I mean, they're so if you're very familiar with LTL, there's periods where you're trying to maximize volume, and then there's periods when you're trying to manage yield, and they're definitely in yield management at the moment. And just to kind of clarify for our audience what that means, there are times when you want revenue and shipment, so you're less interested in the price per pound and more interested in getting as much freight as you can. Right now, the trailer is going to be full, so they're trying to maximize their dollar per pound. And from a yield management perspective, they might not want to take the lower dollar per pound freight and substitute it out for the higher price per pound type stuff. Are you seeing the same thing, Dean, or something different?
Absolutely. From a capacity point of view, I'm seeing a lot of carriers are quite busy pulling the pup trailers around. Carriers that would normally be hauling flatbeds, dry vans, for example, have shifted into the LTL space to pull those 228-foot pup trailers for the big LTL carriers.
Yeah, and I wanted to add to something that Ken said, and that yield versus volume management is something that actually makes modeling the LTL side kind of frustrating because you get very different dynamics, unlike with van, where it's a little bit simpler to kind of model what's going on there. So that's been something that we've been interested in doing, but it's hard to kind of normalize the loads that LTL carriers are hauling, so you can get like a consistent week over week number that trends in a good way.
Yeah, LTL is an interesting, not paradox. It's an interesting problem in general because you introduce freight classes which don't exist. A pallet of paper is a lot different than a pallet of packing peanuts, right? And then you have this expedited versus economy. So you have different service levels, which you don't necessarily have with point-to-point truckload. And then you have volume, which throws a whole. And for those not familiar, volume is when you're, what is it? Usually about 10,000 pounds. Dean, I'm a little rusty.
Yeah.
So you have a lot of volume freight. It's interesting to see. The thing I'm watching, we had this conversation earlier this week, is what levers shippers start to pull. Because the question comes in, like, we talk about pulling levers. Well, what can they do? A lot of what they can do involves slowing freight down. So they might be more willing to wait to have things move intermodal where they can. They might move more things through LTL on economy versus expedited, and just generally try to avoid paying $2.25 a mile plus fuel for their point-to-point truckload when they're contracted probably at $1.75 to $1.80.
So Ken, on that, we talked to some truckload carriers last week where they've been building full loads essentially out of multiple LTL consignments. And running, because there's in their particular sector, like industrial sector, volumes are way down. So they've been able to build profitability into their lanes by taking a little bit more time to build more LTL consignments into a higher rate per mile.
So we have another question coming in from Giovanni. He was asking about the forecast model, and he wanted to know what our blue line was based on. So that is the historical market rate observed by DAT. That is a blend of RateView national rates. So if you are a RateView subscriber and you look at the national rate, we're essentially taking the RateView national rate and tweaking it a little bit to account for different classes of long-haul freight, and that's generating that blue line. Oh, and it looks like we have one more question. Sorry. Hope that answers your question, by the way, Giovanni. From Max, we are seeing an unusually tight reefer market out of Texas with high prices. What's driving that, and how long do you expect it to last?
We talked about that a little bit earlier when we looked at the market condition index. I think that's what they're talking about in that particular question. It's got to do with produce imports in particular from Mexico. That's driving up a lot of the volume. So that's why we saw that 13% week over week increase along the border markets. Some of those markets, like you can go to El Paso, Laredo, their freight kind of splits directionally, east and west. When you get to El Paso, a lot of that freight comes up from Mexico, particular products like avocado from central Mexico, and then they make their way to California. Whereas Laredo and McAllen markets, a lot of that freight heads towards the east coast around Atlanta and as far as New York City. I think the answer to the second part, that should slow down though. As you start to get deeper into the winter months, import shipments across the southern border slow right down, and then you start to see imports for the US to meet US demand come from overseas countries. So that's where markets like Houston, Philadelphia, and Los Angeles start to pick up more imported produce from the southern hemisphere.
Makes sense. I had one more question I wanted to get to before we wrap, and it was actually from last week, so I wanted to make sure we didn't let it sit for 2 whole weeks. But this one's for Ned, and basically with how the the flatbed map looked, the question came up, can the whole map be read or at 100?
So those are 2 separate questions, and the answer to those are respectively yes and no. So particularly for flatbeds, the way that we do normalization, where we normalize differently based on equipment type, the whole map is certainly possible to be read. It is not possible for the whole map to be 100. But given the way that we do normalization for flatbed, it is certainly possible for the whole map to be read. And that's because with flatbed, the way that we're normalizing across KMA, where KMA is the key market area. It's sorry to go on a little bit of a digression, but it helps to clarify the point. The key market area is the kind of DAT base unit of market. So it is an agglomeration of 3-digit zip codes. Each key market area is unique in the sense that no point lies in more than one key market area. But the key market areas specifically do things like cross state lines, because you get situations like something that I'm familiar with, the Omaha Council Bluffs area. Like that's essentially one big market for freight. Like one's in Nebraska and one's in Iowa, but it's all one big market. But you also get splitting. So like, for example, in the Chicago suburbs, we have a lot of different KMAs because the way that freight is being handled, like inner loop Chicago is very different than like Darien, Illinois. And so you get different KMAs in those spaces, even though geographically they're very, very close. So with the MCI, what we're looking at is we're kind of normalizing across KMAs to look at the amount of volume that is traveling through. And the way that we are normalizing for flatbed makes it more likely for flatbed that the whole map can be read. But yes, the whole map can be read. The whole map cannot be 100. And it might be instructive to look at the actual numbers. I don't have them on hand, but if you look at the numbers, there's a fair bit of, I mean, you're talking about like 6 points, but there's some travel in those 6 points, and you can see the different markets are behaving slightly differently.
Great. Thank you. I hope that answers the question.
Yeah.
So with that, I'm going to wrap us up for this week with some housekeeping items. So if you enjoy our content, if you like watching live, we encourage you to like and subscribe. It'll be the best way to get notified when we have new content or when we're going live. We have Dean's full market update, which is packed full of really great content and timely insights. That's at dat.com/market update. And then lastly, if you have any questions that you didn't get a chance to ask during the show, or you just think of during the week, askiq@dat.com is the best place to get in touch with us. So with that, we're going to sign off for this week, and we hope that you join us live next week. And I hope you guys have a great week, Ned and Dean.
Thanks, Ken. Thanks, Dan.